Welcome, everybody, to another happy hour with Jason Hartman, yours truly, George Gammon, and Ken McElroy. And we also have a little bit of a ghost person here with us as well. You might meet her.
I know. Hi, Danielle.
Hello, everybody. I'll be taking some of the questions for you.
She's like the voice of God. You can hear her.
That's right. Be careful.
Hey, hold up your drinks, your stiff drinks. It's stiff drink time, people. Cheers.
Silver bullet.
George, no drink, huh?
Oh, no, I've got some water.
Yeah, cool. Well, hey, so maybe we'll start off. Kenny, we were talking a little bit before we started. I just wanted to ask you, I thought that was an awesome video you did on your YouTube channel about the, possibility of a change in the real estate market with moratoriums ending. And George probably saw that one too. I'm sure he's talked about it.
I'd love to get George's, weigh in on this, because I don't know if you guys have seen his reverse repo video from last week, but it's
Ken, can you come a little closer to your mic?
Yeah. So I'd love to get George's view on this too. So there's a few things happening. Well, I think that we're getting into an affordability time, and we're going to start to see. I don't know if you know, but mortgage applications are at their lowest point in a year for single family, and they're typically an indicator for obviously growth and demand. Now that's only one thing, but then we have this forbearance and we have the eviction moratorium ending. Hopefully, we'll see. But so I believe that there's going to be a bunch of people are going to be listing in this, the second half of this year and early into next year, because they have liquidity and they have they certainly appear to have a lot of equity in their homes. I know there's all kinds of numbers around this, but I've seen as much as 1 trillion in equity over the last year as a result of some of these increases. So I think that most people aren't going to be in too much trouble from a default standpoint, but we definitely could see a supply added, and so that's what I was trying to talk about. It's going to be market to market, and not all markets are the same. So if you take a look at Atlanta and a lot of places in Texas are actually, some of those are some of the higher forbearance, have some of the higher forbearance numbers than, some of the other parts of the country.
Did those mortgage numbers include refis?
No, this was just, on the applications. Yeah. On the applications for sure.
It included refis.
Yeah. So that's
Wow.
That's what I found was really interesting. And I think what's happening, George, is what I'm hearing is, I'd love to hear your spin on this, Jason. People are having a tough time on the appraisals. So because they're bidding so much higher than the listings right now, as you know, I think 50% of the sales have been over listings. And so, which is an incredible number. And so they have to come out of pocket, you know what I mean? And so we're pushing this affordability. I think, for the first time in a long time, we're starting to see things really, really slow down in the single family market. But it's going to be interesting. I think that, it doesn't necessarily mean that there's going to be a housing crash. It might just get absorbed, because some of these markets, have 8, 10, 12 bidders on one home.
And I think a lot of it depends on stimulus, Ken.
Yeah.
That's if we see a lot more direct stimulus in the form of UBI or whatever you want to call it, just in was it March or so, January, incomes in the United States on average went up by, it was north of 20%, and that was because of the transfer payment in just 1 month. By the way, just 1 month. So now some months it goes down, some months it goes up, depending on how much money the government is doling out. But if the government really decides to get even more aggressive, which I think they'll have to, unless or we're going to see some serious deflationary pressures in asset prices. But if they continue to spend like they have been, and it becomes more and more and more and more and more like we saw quantitative easing, then the consumers might have more money, or more dollars, I should say, to come up with higher amounts of down payments, because the interest rates can't go any lower. At some point, the incomes have to go up or the interest rates have to go lower. And when you're at the zero lower bound, on Fed funds, it's very difficult for those interest rates to go lower. So something's got to give. And the only way to get incomes up really in an economy that has been this distorted by government, ironically enough, is for governments to distort the economy even further by doing more stimulus checks.
It's a game they just can't get out of. Once they
Yeah.
go down this hole,
Yeah, that's right.
they just have to keep perpetuating this whole thing,
Yeah.
don't they?
Yeah, it's just like QE. Just like QE.
Yeah.
Same thing.
I know that, it's interesting. Here we are now, I don't know, 14, 15 months past the pandemic when it started. And as a lot of people know, there are landlords that got hurt pretty good and, or were having issues. But most of the ones that I know actually did get paid because, through some of that stimulus. It did go to the some of the folks, and then they ended up paying their rent. And most of the landlords I know were not obviously trying to displace anybody. And we actually I think that they're going to have to continue to give money either to the people or to the landlords, because we're now we're heading into what I consider to be a 3 to 4 to 5 year, very, very aggressive rent growth time frame because of the shortage that is. So if you own anything today, or considering buying something today, depending on the market, of course, I think you're going to see massive rent growth now that this pandemic's over. And even though we're going to have some of, obviously millions of people are going to be moved around after this eviction moratorium ends, but there's a pretty good shortage of rental housing.
You talk about single family, Kenny, or multifamily?
Yeah, it's kind of both. It's interesting. It's a great question, George. In 2008, what happened, I think if people can, they will definitely rent a house. There's no question. They'll rent a house or they'll buy a house over an apartment. That's been my experience. But, as the affordability pushes up, they're going to start to look for nice places that are more affordable. So this happened in 2008. We watched it. Very different scenario, obviously, where the housing prices were less than the mortgages and, they had to bail. But in this particular case, I think, we've seen these housing prices go up. And to your point, interest rates cannot go down anymore. So if they start to hedge interest rates up, which they're certainly saying to tamper inflation, let's say, then that's just going to create more affordability issues. I think that's going to push more people down into the rental market, because if you're buying a home, let's say just to own it, it's one thing. But if you're buying it to buy, for Airbnb or potentially to rent, your cash flow is definitely going to get squeezed, at least on the short term, with these higher interest rates.
One of the other interesting parts of it is the institutional players in the business buying so many single family homes, and their plans are to buy a lot more. And you know what? They are much better at maximizing and optimizing rent increases, in other words, than mom and pop landlords are.
Yeah,
they're very good at that. And so I think that alone, just that component of the market, will cause higher rents. It's amazing. If the government wanted to solve the problem of the housing shortage, right? All they need to do is loosen the building restrictions, embrace the free market. And if they want to incentivize anybody, why don't they incentivize developers to build more stuff, right? But of course, it's always bass backwards with the government.
So I actually looked into it. I was on Bigger Pockets last week and talking about this issue about big business. And I wrote down some things, and I'll kind of, everybody's talking about Blackstone and JP Morgan and Brookstone Asset Management and Rockpoint, and those are kind of the big ones that are out buying these big chunks. But as you know, Jason, it still represents somewhere between 1% and 2% of the housing. Like it's such a small number.
Overall, I agree with you. It is a drop in the bucket when you got like 18 million, single family rentals owned by mom and pops. They're still tiny, but man, they can scale fast. And
here's what I think.
Is that a percentage of ownership or percentage of buyers? Because that's two different.
Yeah, so
percentage of ownership, I believe.
Yeah, so
see, but that doesn't. I don't know that means much. If it's just 2% of ownership, I'd be curious as what percentage of buyers. But
yeah,
anyway,
they're I think last we looked, well, they bought Invitation Homes, which had 30,000 houses, just to give you some perspective. And that was, and they bought it for $10 billion, and they put $2 billion into that deal. And then they took it public and they made $7 billion. So,
Yeah.
and now they just bought into Home Partners of America, which has 17,000 homes. So the big money is actually chasing more of the bigger groups, George. What I see different in this particular, this could be something very, very different, where these guys are buying these in bulk, and then what's happening is they're actually doing rent to owns. So you know, traditionally that has never been a real heavy market. And I think that a company like Blackstone or JP Morgan can actually come up with a rent to own program where a piece of their rent payment goes against the future ownership. This could be a whole new market coming up, I think, and it's already starting. And and they've had massive management issues, as you guys probably know.
Yeah,
massive
we've run those stories about their management complaints. But I think they know, Kenny, that the rent to own deal is, at least historically, people don't exercise those options, right? They don't end up buying the houses at the end. I was looking at a story just maybe yesterday where a guy sold his house to one of the institutional buyers. I can't remember which one. Sold it for like $182,000. They let him rent it back for 5 years on a rent to own deal for $1,600, which I thought was a pretty great rent to value ratio for them. But the likelihood of him buying that house at the end, at least from what we've seen historically, is relatively low. Which is
so. George, you'll love this stat. From 2001 to 2020, there were 276,000 homes per year less built than 68 to 2000. So in other words, on the average, there were 276,000 homes per year not delivered during this time frame where we had these population growth. So that equates to, there's a great article in Forbes and Wall Street Journal that came out in the last 2 weeks that says we actually need 5.5 million homes.
Yeah, NAR is that.
It's a crazy, crazy number. And even the National Association of Realtor said we need 2.1 million homes each year for the next 10 years just to keep up.
That's not going to happen.
No way, not even close.
And I think they may be missing a very crucial point there, because I would say let's dive a little bit deeper and not ask how much the differential between the homes being built, but the differential between the amount of square footage being built.
Yeah,
because you see the amount, an average size home being built between the 50s and 2000 was, let's say, what, 1,500
it's
square
much
feet.
bigger
really
now.
small.
Yeah.
And between 2000 and today, I'd say the average size home is maybe 2,500 square feet.
Right.
So my point is, they're probably building a similar amount of square footage, but it's all going to those larger and larger homes. Therefore, the discrepancy in what we need at the lower end, at the starter home, is even greater than that article would imply.
That's a really interesting point George makes. Just one more thing to add to that. The houses, in terms of square footage, are getting much larger, but the land is getting much smaller.
Yeah,
a lot of those are townhomes. A lot of them are little villas with attached on one side or whatever. So the interior space is getting bigger, but the lot sizes are just shrinking like crazy. Yeah,
because the builders can't make any money on anything under 2,500 square feet.
Right.
Yeah.
Because most people don't really understand, and just for the viewers who just kind of might not, they say, well, why, if I'm paying $300 a square foot, why isn't it just $300 a square foot for the builders? Because you only have one kitchen, you only have one master bathroom.
Right.
So people need to understand that adding 1,000 square feet that does not include a kitchen and does not include a master bathroom is a hell of a lot cheaper than adding 1,500 square feet that includes
plumbing.
plumbing or cabinets or granite or quartz or all these things. So
much more expensive to do kitchens and bathrooms than just rooms.
Yeah, and whether you've got a 3,000 square foot house or a 1,200 square foot house, you still have one kitchen.
Yep.
Yeah.
So that's why the builders can make money or much higher margins, or margins that make sense from a risk reward standpoint at a 3,000 square foot home, and they cannot at a 1,200 square foot home.
Yeah.
And they've got to deal with a lot fewer buyers, so the sales process is less expensive and everything. Yeah, it's pretty interesting. So Ken, though, back to the original thing, you did this analysis of how many homes might come on the market to cool the market down a little bit, and it really wasn't that much. I mean, if people are looking for a crash, the crash boys are still gonna be wrong, right? Is that
when I did that video, I think we had like a 2-month supply, and I think the average is 6, and now it doesn't appear like we have much of a supply at all. So it does have to kind of unwind a little bit. And also I think it's going to be very, very driven by, a lot of different factors in each individual market now, especially as people have moved around, and the work from home thing is so different. You're going to have, I think you're still going to have some urban areas that are going to be kind of long-term slide. And the rural areas are, just not too far out of some of the urban areas are actually doing very, very well. And I think that's what you're starting to see in some of these lower priced markets that are just maybe 30, 45 minutes away.
Mr. Mobile, you guys, Mr. Mobile had commented that.
I was going to do the same one. Yeah.
Yeah. He was asking about if you guys are seeing a shift in the housing market, and also that California, he's seeing a big price drop.
Yeah. Which surprises me. And Daniil, I was wondering where in California. That's what I want to ask Mr. Mobile. Where in California? Please be more specific than that. I'm wondering if that's one of the really trophy urban markets or Inland Empire, or what are you talking about? So let us know that. And by the way, everybody, comment in the comments down below. Tell us where you're located and what you think is going to happen. We'd love to survey you and hear what you have to say.
Hey, by the way, guys, I'm excited about our November 5th event, our first mastermind we're going to do together with the three of us.
Me too. That's going to be real exciting. So, we haven't fully and completely announced this. So, George and Ken and I started a new mastermind group called The Collective, kind of a spoof on collectivism, if you will. Definitely not collectivist, but Ayn Rand called her little group The Collective when she met with Alan Greenspan and Nathaniel Brandon at her apartment in New York City years ago. And Ken, tell us a little bit more about the event in Scottsdale in November.
Well, I think you guys know, we all we study like this all the time. I mean, we're on the phone with each other all the time, and a whole bunch of other people from a network standpoint. I know all three of us are. And we just decided that it would be fun to get together live, the three of us, and because we're in such, different industries, and be able to, meet with people, talk with people, and hopefully help people make some, good decisions around some of the things that are certainly heading this way. And I know we're putting together our board of advisors, and we haven't completely solidified that, but I can assure you they're going to be good people there. We already have commitments from Kiyosaki. Robert said, I'll do whatever. I'll be there for sure. He just wants to learn. Mark Victor Hansen, of course, who wrote Chicken Soup for the Soul. And we have a few other people. I know you got Robert Barnes coming, George, which I can't wait to chat with him a little bit more. And so, we're all just going to meet live in Scottsdale on November 5th, 6th, and 7th. And we're in the process of putting the whole program together. It's going to be very exciting.
And so
4 times a year.
We meet, as George was saying, so we meet 4 times a year, and there's the website on your screen. It's thecollectivemastermind.com. It's a mastermind with the three of us. So you've got the trio, thecollectivemastermind.com, And like George was saying, 4 events per year, as well as our connection concierge and a whole bunch of other things we're doing to just make this the greatest mastermind group ever.
Yeah, it's not for everyone. I mean, I
Yep.
think I think if you're wondering if this is something that's for you, I'd go to the website and check it out. I think the net worth of the individual needs to be at a certain point, or it's not really going to be. Oh, it'll definitely be worth their while. But I think that there's a lot of factors that go into it. So I would check it out. I think the goal really is to set up something that that I wanted to be a part of in the first place. When we told the story at Rebel Capitalist Live when Kenny and Jason brought this up several months ago. I didn't really know what a mastermind was. I had no clue. I'd never been a part of one, and so they told me about it, and I said, "Well, that's a good idea. That makes a lot of sense to me." But instead of just going out and joining some random mastermind, that didn't really appeal to me at all. So what appeals to me is setting up my own based on what I think would be interesting from a learning standpoint and an entertainment standpoint, and doing things that you just cannot do outside of the group, such as driving race cars with Danica Patrick, or we just went down to the hotel the other day to set up the fashion show that we're doing. It's exclusive to the group and the members, and but then also bring in the consultants and the board of advisors to help people really grow their wealth and thrive in this world of out of control central banks and big governments. So there's a lot of things to be excited about. It's not for everybody, but you go check out the website and see if it's something that might be a fit, and if it is, send an application in, and we go from there.
Yeah, and it's just a little quickie application. We just want to kind of know if it's, this has to be kind of a mutual fit, as George is alluding to, for the group.
Yeah, I have a certain amount of members. I don't want this thing to be really big. I want it to be very small, intimate group. And so, I just think that, we need to make sure that it's right for you, that we're right for you, or the mastermind is right for you, and that you're right for the mastermind, because one of the biggest values of the group itself is the networking opportunity between the members. It's not just about me, Jason, and Ken and all this. It's about the that's what I'm really looking forward to, is getting a group of guys and girls together that have an immense amount of brain power, and combining the networks to leverage what I'm doing and to really help me grow personally and professionally. And so we want to be careful about the people that are coming into the inner circle, if you will.
Yeah, I know over the years I've had a lot of people, and this is part of the reason that I'm excited about it. I've had a lot of people ask, do you do any live events or do this? And I don't, as you guys know. So for me, I'm doing deals, and that's what I do full time. But and when we were talking, I said I could definitely commit to 4 weekends a year to teach people everything from raising capital, syndication, how to buy deals, and create long-term wealth. So I'm excited. 4 weekends a year is easy for me to do, and like to your point, George, the people that have already reached out, they're incredible people. The applications that have come through, there's some people out there really moving the needle personally. Oh, yeah. And I'm excited to meet everyone and to get everyone in one room and learn together. Because I think that's where we're heading, guys. We have to have different viewpoints and different ideas moving forward with all these policy changes and all these political changes, and the landscape's going to be very, very different over the next 5 to 10 years.
Yeah. At no point in time has there been a greater need to be aware of the world around you from a standpoint of economics and unfortunately politics. I just think that it's really unprecedented. Well, I shouldn't say it's unprecedented. It's because this is all cyclical, but it's unprecedented, I'd say, in the last, call it 100 years, 80 years, something like that. We're at the end of a long-term cycle, not only a long-term debt cycle, as Ray Dalio points out, which means we have to have a deleveraging whether it's a deflationary deleveraging or an inflationary deleveraging, the system has to delever. But I think from a social standpoint as well, we're at the end of a cycle, and whether we're going to go to a more centralized system or a more decentralized system, that's the question. And whichever, obviously I would prefer that we go to a decentralized system in the West, but the probabilities are probably low. So you can sit there and bitch about it, or you can get together with a group of like-minded people and help each other take advantage of the opportunities. Because the one thing, I love Doug Casey's definition of a speculator, and that's someone who takes advantage of the incompetence of government.
I love that too.
I think we're going to have, on the bright side, we're going to have a lot of that. We're going to have a lot of opportunities to do that in the future.
Yeah, that's for sure. And, it was amazing because, George, at your event, Rebel Capitalist Live in Miami, that was, I guess, a month ago now, probably, right? We announced it there. And that's really been the only announcement about the collective formally, other than right now. And we recruited, I believe, we enrolled 14 great people. And it's just super excited. I mean, like Ken said, there are people really moving the needle. So these are the members, and then also the guests and the speakers and so forth. It's just going to be an amazing group. And I just wanted to mention one thing. The plan is these 4 events per year, but 3 of them are planned to be weekend events, and 1 is an actual vacation event, like maybe 5 days or a week long. We'll see. It depends on where it is and when and so forth. But I think I think there's just going to be a ton of learning and networking, and people just having the opportunity to up level and take things to the next step. It's not what you know, it's who you know, and that's the big part of the mastermind. Is you get the what to know, but you also get the who, and that's a very, very powerful thing.
Yeah. While having fun.
Having fun too, absolutely.
We want to meet with all the pros that I talk to on Rebel Capitalist Pro. We want to bring them in so you can learn from them in an intimate type of exclusive VIP setting. But we also want to go out there and race Ferraris with Danica Patrick and get some live entertainment and do shows and bring in a bunch of people that you probably otherwise wouldn't meet, not only from an educational standpoint, but an entertainment standpoint as well.
Yeah.
We're thinking about bringing in Sheryl Crow to do a performance Saturday night just for the group. So I don't know that that's going to come to fruition, but it gives you an idea of how we're trying to combine the educational component with the entertainment component of it. Because again, if it's something that I'm a part of, I want to create what I want. And that sounds like a blast. That sounds like something that would motivate me and that I would enjoy. So there you go.
Yeah. And I would also, one other thing, as you guys know, when we were deciding on putting this whole thing together, we all said, let's give each member every single thing that we have. So our premium memberships, any courses or anything like that, that's all included in obviously the collective membership. So whatever Jason has or George has or I have, that's all part of this. But I think ultimately the best thing, George, having been involved in EO, I know, Jason, you have, and now YPO, are the relationships and the networking that you guys will get from the folks. If the first 14 people that signed up with almost no advertising are any indication to, the people that are going to sign up afterwards, then I think people are going to walk away with just an incredible network of people that they can draw on. And you find that, at least my experience has been that I think everybody's kind of has the same set of questions largely, about savings and money and investing and estate planning and all those kinds of things. And so we're going to be tackling a bunch of issues around that, in addition to what we see forward. Because when we're investing our own money, all 3 of us even, everybody's kind of doing the same thing. We're all trying to figure out what do we do with it, and how do we do it, and what's going to happen, and what side of the equation, to George's point, take advantage of the incompetent government right now. So what are the things and what are the strategies that we can do in order to be on the front side of that.
Yeah. One of the things I'll tell you, it's funny because all three of us have very different backgrounds, but we've come together, right? So, we've all had very successful business ventures. We've all had very successful investing ventures, and George hasn't been in mastermind groups. I've been in several of them, and it has been the quickest way toward progress. I mean, that's just been the quickest thing for me. I've done a lot of things myself, but being a lone wolf, you can only get so far, and you can't go nearly as fast. And with knowing the right people, the who, not the how, just a super powerful thing. And also, those comments that both George and Ken made about the fun side of it, right? What I always say is that the stock and trade of friendships, of long-term friendships, is shared experiences. And so we want to make some really awesome sort of once in a lifetime bucket list shared experiences for all of our members so that they can just bond and they can accelerate those friendships more quickly. And out of that grows all sorts of connections and just a whole really a new paradigm of growth in one's life, in their career, in their business, relationships, whatever. So yeah, looking forward to some really good stuff, guys. You want to get to some of these questions, Danielle?
Yeah, let's do it.
Are you looking at those, or should we just grab them?
Go ahead, Jay.
Yeah. So I love it. My tinfoil hat is here, George. That's one of the best handles ever. So higher wages drives higher costs of goods and services. Says that employees are demanding more money, and definitely not transitory. I agree with that. George, it sounds like you're talking a bit about deflation tonight. So do you want to share your thoughts about the future? Is it inflationary, deflationary, or a combination? Probably a blend, right?
Yeah, well, it's like most things. People try to figure out a super simple answer to a complex question. And you have to start by understanding that there's multiple cross currents at play. And then once you understand that, you have to determine how dollars are created. And so, because that's the end metric that really determines whether or not we have inflation, is the amount of dollars that are circulating, chasing goods and services. So dollars in the past have been created by the commercial banking system, because when they create a loan, they create more dollars. Those dollars did not exist prior to them issuing that debt. So let's say they issue a loan for $1 million for you to buy a house. It's $1 million. It didn't exist. It wasn't circulating before. But at a certain point, the banks can't lend because they're constrained by a profit and loss. So if the risk reward just doesn't make sense, as an example, everyone in the economy tanks. It's very unstable, I think would be the right word, because right now I think the banks realize that the whole entire thing's being propped up by government spending, government deficit spending, and you just don't know how long that's going to continue. How long are these rent or eviction moratoriums going to last? How long are the mortgage forbearance programs going to last? How long is UBI going to last? These are all questions that we just don't know, nor do the banks. And so you've got to put yourself in the position of a bank, and let's say that you had $1 billion, but one of your buddies came to you that didn't have a job, that was very unpredictable, that never kept his word, all of these things. And he says, "Oh, Jason, I need a loan for $10,000. You'd be like, "Well, I don't know.
Maybe not." Yeah.
Yeah, because even though you have $1 billion, you're not getting paid back. But if you've got someone that is a great credit risk, then sure, okay, here's $10,000 at an acceptable interest rate. So you see, it's not just about the banks having all of this money and all these bank reserves and all this balance sheet capacity to create more loans. It's the demand side of the equation, and it's the side of the equation that where the entities and the individuals in the real economy, if they're actually worth lending to from a risk reward standpoint. So once you get to a point where the banks really can't find any good loans to generate at scale, the amount of dollars in the system decreases, because when people pay back their debt, that decreases the amount of dollars in the system, just like creating no new loans creates more dollars. You see, and we just
money is lent into existence.
George,
That's
I had
right.
a question.
And it's decreased, Jason, when you pay the loan back. So if you have more loans that are being paid back than are being generated, you're going to have fewer dollars in the system chasing goods and services, which would be highly, highly deflationary, especially for asset prices, because on the supply side, with the consumer goods, the supply can go down even faster than the amount of dollars, and you still have consumer price inflation. But that you've got to compartmentalize the assets, the consumer prices, and then the dollar against other fiat currencies as well.
So this
George,
is related.
I had a quick question about Wells Fargo.
Yeah.
Wells Fargo came out this week.
I was just going there. Yeah, I was just going there.
Wells, pulling in all the credit lines.
Yeah. So for those of you who don't know, Wells Fargo called all their lines of credit, which basically means that they stopped lending to a lot of folks that are customers.
2 million, I think.
Yes, 2 million people. So what, when you see that, George, what do you see? I've been trying to wrap my head around it. I've gone to YouTube trying to figure this out. Yeah. What are you seeing there?
It's counterparty risk. So they see counterparty risk. They see an economy that they hope does well, but everything's up in there. Nobody knows what's going to happen. It's completely unpredictable. And therefore, they're trying to pull back their risk, and they're saying, hey, these most likely, and I'd have to read a press report to see what they say and how they spin it, but I think it's just a matter of counterparty risk. The risk reward doesn't make sense to them, or else they'd be doing it. If they could make money on it from a risk reward standpoint, they'd be doing it, right? So I think but that just means fewer dollars. Right? Because those loans, those lines of credit would have been more dollars being created once those lines of credit were drawn upon. Right. So that's another example of fewer dollars. What we're seeing in the reverse repo is a massive, massive decrease in the amount of potential bank lending moving forward. I mean, that could have actually had something to do with it right there, Ken. In fact, I should probably include that in my next whiteboard video.
Yeah, I saw that. It's like $1 billion a day or something now, right?
Oh, no, $1 trillion.
$1 trillion a day. Sorry, I'm just off.
A shocking amount of money. Yeah.
Yeah. I think it last week is down to like 750 billion, but the week prior it got up to almost 1,991 billion. But so what most people don't understand, and it's very difficult to explain without a whiteboard video, but when a money market fund who has an account with the commercial banking system, when they move their dollars to the Fed, that means that let's say they had an account with Wells Fargo, and that means the $1 billion that money market fund moves to the Fed, it goes from Wells Fargo, their bank reserves, down into the reverse repo account, which is still a liability of the Fed, but that means that Wells Fargo has $1 billion less of balance sheet capacity or lending capacity, you see. And so you say, well, let's connect these dots, and how many bank reserves are in the system? How many bank reserves are out there that banks have to use to backstop new loans or to create new loans? Because they're not really lending out the bank reserves. I want to be clear there. They're only using those bank reserves to backstop and to give them balance sheet capacity to create more loans. But there's about 4 trillion in bank reserves total, right? Well, if you've got 1 trillion, 25% of those bank reserves going into an account that's still a liability of the Fed, but where the banks don't have access or cannot use them anymore to generate more loans, then I mean, think about that. That's a 25% of the balance sheet capacity just gone instantly. So that's all things being equal, that is wildly deflationary. And also, if you see bank lending going back to 2020, you see that it's actually decreased. Once we got past all the PPP loans, it really shot up. But once we get past the PPP stuff, it starts to go down. We've been in a downtrend with commercial bank lending ever since. And when you're taking $1 trillion of bank reserves out of the system nightly, and that persists on a long-term basis, that I'm not saying they're going to lend less, but that's got to be a huge, huge, huge headwind to future lending, which means fewer dollars being created. And I want to be clear, I'm not saying that consumer prices go down, because I think supply will go down at a faster rate. But I am saying that puts downward pressure on assets for sure. So what's the counterbalance to that? Well, that would be the government coming in and creating more dollars by deficit spending and having the Fed monetize it. Because now we're in this hybrid system where it's not just about the commercial banks creating and destroying dollars through lending and those loans being paid back, but it's also about the federal government deficit spending, and they're not drawing those dollars out of the system in the first place. Because usually when you would go to a treasury auction, the individuals or entities in the real economy would buy those treasuries. So those dollars would be sucked out of the system. And then when the treasury spent the money and redeployed it to other areas of the economy, they would take those same dollars and put them right back in the system. So on net balance, the amount of dollars created or destroyed would be zero. It would be flat, right? Then it goes back to the on margin, what's going up or down is what's happening in the commercial banking system. That's usually what happens. But now a lot of those bonds are being purchased by the Fed, and they just create new bank reserves to do that. So when the money is spent back into the system on net balance, it's an increase to broad money and M2 money supply. So that's why we haven't seen significant deflation since March of 2020, is because the government has filled the hole of dollars not being created by creating dollars themselves. But see, then that's where we move from an economic question to a political question. And I think we'll go to a central bank digital currency, where then the central bank, the Fed, will take total control of lending, which means they finally actually do have control over the dollar, which is what most people think or have thought they've had control of for decades. But once you study it, you realize the central banks really aren't central to anything other than expectations policy.
Right. And I wanted to grab this question because the Fed has been distorting the market by being not only this lender of last resort, but buyer of last resort. So Tom asked this, and you can see it on the screen. How far do you think the Fed will go? Are they just going to keep buying up everything? Right.
Yeah. I mean, I think they will, but I don't know that they'll have to in the future, because they might not be they will be the lender of last resort. They may be the lender of first resort from a standpoint of, if we all have accounts with the Fed, if they go to a Fed coin, which is what I'm implying, then you would get your loan directly from the Fed. So they'd own the lien. They wouldn't have to buy it all, because you'd be getting it directly from the Fed in the first place.
In that world, what happens to the banks? Do the banks just go away, or are they like just branches of the Fed, like a franchise almost?
Yeah, I think they already are kind of.
Yeah, well, I know, but I mean, like they are now, or
yeah,
they don't have Jamie Dimons out there, for example.
Yeah, well, see, the big difference between the Fed lending and the commercial banking system is one has the constraint of a profit and loss, and the other one does not.
Right.
So you could have, as an example, the Biden administration wants to promote lending to XYZ disadvantaged group. Okay. So if that individual within that group goes to Wells Fargo and they get a loan approved for a 4.5% interest rate, they can either choose that, or they can bid it out with the Fed and the Fed can say, okay, well, we'll give you a 2% interest rate because you're part of this disadvantaged group. So you still have the commercial banking system. They can still kind of bid on it. But if you're part of specific groups that are in political favor at the time, then you can go to the Fed and ask for a loan and potentially get a loan with much better terms directly from them, kind of a subsidized loan, because they can lend to people and not have to worry about getting paid back. They can, bottom line is, they can lend to people for different reasons.
So they can do the Community Reinvestment Act, in other words, and make unprofitable but politically correct loans.
Yeah, right. Right. Yeah, because once you have the Fed in the game, then you have basically individual monetary policy, meaning the interest rates and your access to dollar denominated loans is not really a result of the broad society, but it's based on you, just your. So as an example, the Fed right now says, okay, the Fed funds rate, overnight rates 0 to 25 basis points. So that's this broad, throughout the whole economy. That's what they're saying. So then the banks have to determine a rate of risk and all these other things to come up with an actual mortgage rate. Where in the future, it might not be, well, interest rate, we're setting interest rates at 0. It could be, well, interest rates for Jason Hartman are 2%. Interest rates for Kenny are 3%.
See, I'm in a special group. I get 2%. Yeah,
You're a better credit risk.
Yeah, well,
I think
it would be. Yeah, it could be based on. I think it'll be based on things other than your credit score.
Yeah.
So, but then the point is, though, it gives them much more control over inflation. And even if you have the deflationary pressures of the commercial banking systems lending less, I think the Fed will be able to combat that if they have that digital currency. If they don't, then it's really just up to the government deficit spending. And again, that's why things get so complex, because we go from trying to answer economic questions to trying to answer political questions, and political questions are much, much harder to answer.
Yeah.
So George, one of the things that you mentioned in your video, which I was trying to figure out, so now they have you live, you said you think it's a collateral issue. Can you talk a little bit more about that?
Yeah, and I think that goes to a counterparty risk issue, because when the Fed does a reverse repo, the Fed, from the Fed standpoint, it's actually a repo, because a reverse repo is the same transaction, just from different counterparties. So when a bank says, okay, Fed, we'll give you our money and we'll take your treasuries as collateral, from the bank standpoint, that's a reverse repo, a reverse repurchase agreement. So what's happening there? The common idea is that the banking system is just flooded with dollars because of the Fed's doing QE, and therefore they just want to park their dollars with the Fed. But that doesn't make a lot of sense, because they could get 15 basis points in just their reserve account. So why would they move it down to an account where they're only getting 5 basis points? That doesn't make a lot of sense, unless they want the collateral, because they can make more than those 10 basis points on having the treasury bills. But then most people come back and say, yeah, George, but 90% of the transactions are with money market funds. Okay, well, that's fine. But you've got to look at, the money market funds taking those billions of dollars and then parking them at the Fed for 5 basis points. Well, number one, wouldn't they have gotten 5 basis points or close to that, or maybe more than that, holding their dollars as a liability of the commercial banking system? Why would they have to put it at the Fed? They obviously would have been paid something by having their deposit, those dollar deposits, in the commercial banking system, whether it's at Wells Fargo, Bank of America, JP Morgan, etc. And then you have to say, okay, well, if it's a cash issue, then why are T-bills trading at 3 basis points? You see, why would those money market funds put their buy T-bills for 3 basis points when they could just park the cash at the Fed for 5 basis points?
Right.
That doesn't make any sense either. So the glut of cash argument, when you really kind of peel back the layers of the onion, it doesn't make that much sense. There's a lot of So then you say, okay, well, it's probably a collateral issue, meaning they just want the collateral. They want all those T-bills that the Fed has been buying through the process of quantitative easing, because they can take those T-bills and use them out in the, to create derivatives, financial engineering. They can basically create a better return by having the treasury or the T-bill than they can by having the dollars in the first place, right? And I get that makes a lot of sense. But for me, I think you got to even take it a step further and say, okay, it's a counterparty risk issue, or it could be, because the money market funds, I don't know that they're taking the T-bills and really creating these financial instruments to make an additional 20 or 30 basis points. I think the banksters, to use Jason's term, are probably doing that. But the money market funds, I don't know that that's really their game. So then you have to ask yourself, okay, well, why would they park all that money at the Fed? And I think if you're looking at the commercial banking system as your counterparty, and you're looking at how unstable the economy is right now, I would rather have my dollars as a counterparty of the Fed than have my dollars as a counterparty of the commercial banking system, because there's no way the Fed doesn't pay you back, right? Because they can actually print the bank reserves, where the commercial bank can actually go under. And to take it a step further, as far as the collateral and the counterparty risk, okay, let's say there is a shortage of pristine collateral, but I think that fluctuates up and down based on counterparty risk, because if the counterparty risk in the actual repo market, where the Fed's not the counterparty, is increasing, well, then obviously the quality of the collateral that they would accept would increase as well, right? So if the quality of the collateral increases, well, yeah, there's going to be less of that quality collateral available, because everyone's trying to get it, because they know that's the only way that they can get the liquidity they need, because the money market funds that are in the repo giving the cash are seeing increased risk, and they're saying the only way we're going to do business with you is if you get some T-bills. We're not going to do business with you if you just give us mortgage-backed securities, or we're not even going to do business with you if you give us 10-year treasuries or 30-year treasuries as collateral. You see, so that again, yes, it could be a collateral issue, but I think that leads you to the question of, is it a counterparty risk issue more so than just a shortage of collateral? Because once that counterparty risk goes up, so does, by definition, you're going to have less, or a demand for more pristine collateral, and then it looks like we have less, right?
Right.
So you outlined some scenarios for deflation. If money's lent into existence, then when lending contracts, money is out of the system. There's less currency in the system. But do you agree, and Ken, I really want you to weigh in on this, please, that all the powers that be, the governments and the central banks, I'm not just talking about ours, I'm talking all around the world, fear deflation, maybe more than anything, because it's a spiraling type of effect, in my opinion. And deflation might be the worst economic malady of all. Inflation, they know how to deal with that. That just is a wealth transfer, right? And it's sad because it impoverishes a lot of people, but it certainly makes the inner class much richer. But I don't think they want deflation. I think
no, they don't. But the central banks, they don't have any control over it.
You sure about that?
I'm 100% positive.
Yeah. Ken, what do you think? Are they, first of all?
I'd ask you,
are they scared of deflation?
How can the central banks create more dollars?
Yeah.
How?
Well, they can loosen lending requirements. And they go to Fannie Mae and they say, make stupid loans, and Fannie Mae will listen.
Yeah, they're already doing that.
Yeah, but they can say get stupider.
Yeah, but I don't know that that's going to move the needle on inflation. It's you've got to have a situation that's similar to Japan in the 1980s, where either you point a gun at the head of the bankers and force them to lend, or the Fed just, to Greg Manorino's point, just buys everything, so there's no counterparty risk
Right.
they just become kind of like a middleman. Or you've got to have the Fed take control of dollars, because right now they do not control
Okay.
the amount of lending at
I
all.
hear what you're saying there, but my question is, do you agree that they are scared of deflation?
Yeah, they don't want deflation because
Okay.
they understand, but you got to compartmentalize deflation. There's two types of deflation. One creates more demand, one creates less demand. So when you have a credit deflation, then that's creating less demand. That's what
Right.
they're scared of, and that's what we have today because of the way our economy has been structured.
Mhm.
If we were in a free market, we would have quality deflation, because the price of goods and services would go
Technology.
down, because there's not as much, we don't have we're not over leveraged, right? It's not a economy that's built on ever expanding amounts of debt. Therefore, if prices are going down, it would actually increase demand. It would not decrease demand. So you've got to look at deflation in two separate compartments, I think.
Okay, so all I'm trying to get at is that I think the powers that be will figure out, if they can, a way to prevent a deflationary spiral. Kenny, do you agree that deflation is what scares the central planners the most? Or do you think it's not a big concern to them?
And again, I think it's asset deflation, Jason.
Yeah.
I don't think it's
I think they're concerned with asset deflation
More than
and,
consumer
to
deflation.
George's point, there are things even today that are deflationary, like big screen TV, or
technology.
a laptop, or
Tech,
an iPad, or iPhone, or whatever. Asset deflation, I think is, because that affects stock market and all kinds of things. I think that's
and
what they're
lending,
afraid of.
because then people can't borrow against those assets anymore.
The
right?
other piece on the inflation side, I'd love to hear George's, with all this QE and future potential QE, which I think we're still going to have, isn't it better for us to have inflation?
Well, it might be better for us to have inflation, but QE in and of itself does not create inflation. If you're defining inflation by consumer prices going up, or if you're defining inflation by more dollars, more broad money being created, all it does is create more base money. So the Fed's balance sheet could go to 100 trillion, and it doesn't mean that the banks will generate one more loan. And if the banks don't generate one more loan, there's not more dollars being created, there's less dollars being created where it actually matters from a standpoint of consumer prices. You see, the Fed QE, that's not really money printing. It's kind of a misnomer. They're just creating more bank reserve. All they're doing, Kenny, I think the best way to say it, when they do QE, all they're doing is increasing the balance sheet capacity of the commercial banks. That's all it is. So just because they increase their balance sheet capacity or their capacity to lend doesn't mean that the banks actually take advantage of that and create more loans in the real economy, especially now, that our economy's been so financialized. Usually the risk reward is favors doing something, in the stock market or with derivatives or in repo or swap lines, as opposed, or lending to hedge funds, as opposed to lending to someone that wants to start a manufacturing company and create goods and services.
So what I was thinking about was back in the 40s, I think it was after the war, we had a real spike in the government debt, and what they did is they let inflation go up. I think it was up into the 4s and 5s.
Yeah, and they pegged the yield curve.
Yeah, over in the 10-year period, and it actually lowered. And it's kind of like what I'm doing with real estate. I'm doing this fixed rate debt. And I know if we get inflation, I'm going to be paying off in cheaper dollars. And so that was kind of the direction I was heading. Do you think that with the government debt and we have this inflationary economy coming, do you think part of their strategy might be that same kind of strategy?
Oh, that's their strategy. Oh, that's 100% their strategy. I'm just saying that if the system stays the same as it has been, they won't be able to pull off the strategy. The system needs to change in order for them to execute on the strategy. And the system has changed. We've gone into this hybrid system that I talked about earlier, where it's not just about the banks being responsible for the creation of dollars. Now it's the government and the Fed kind of tag teaming it with the debt monetization. But then you say, okay, the government would have to create enough dollars to not only make up for the lack of dollars being created by the commercial banks, but also to create enough excess to create the consumer price inflation they need to get the tax receipts up to pay the debt back with devalued dollars and to get debt to GDP down to a much more manageable level. And for that, again, like I said, the system would need to change. The central banks would need to have direct control over how many dollars are circulating. And by the way, most people don't know this, but Alexander Hamilton set up the first central bank that we had here in the United States. And that's right. And his whole purpose for setting up that central bank, if you read, is to create lending for the real economy, for individuals and entities, because they couldn't get any loans from the banks in England. So he wanted to set up a national bank, a central bank, to facilitate growth in the real economy by dishing out loans. And I think the Fed is going to go back to that original mandate that was outlined by Alexander Hamilton.
And I say that's okay as long as the loans are for the real economy and the real people. That would be
and they will be, but it's going to distort the economy further because it's not going to be based on a profit and loss. And it's just going to create fewer goods and services, which might increase nominal GDP just because prices are going up, but it definitely won't make us any wealthier. That's for sure. But then, they can do some things with UBI, and they can put a time stamp on the UBI. So you have to spend it within a certain time frame to make sure that they're increasing velocity. But I think, again, my main point is if the system stayed the way it has been, I think we would definitely see asset deflation. That would be my most probable outcome. But I don't think the system's going to stay the same. I think it's going to change. I think they look at Japan, I think they look at the ECB, and they understand why it didn't work.
So I was in Japan with Kiyosaki, and we did an event there. Obviously, I was talking about real estate.
Ken, what year? Is that recent?
Gosh, this would have been 7-8 years ago.
Okay.
And one of the questions was the QE. We call it QE, but they're just bailouts or whatever you want to call it, I guess. I know you studied this a lot more. How could Japan go to negative interest rates, and how can they just be such high debt to GDP and not see this crazy inflation?
Because it didn't translate into broad money, Ken. It just translated into more base money, more government debt. It didn't really get out into the economy. So as an example, we had look at the Fed's balance sheet from 2008 to call it 2017. It goes up. We do QE1, QE2, QE3, then it kind of plateaus. But M2 money supply, which is it's a bad measurement, but it's a measurement of the amount of dollars in the real economy. It doesn't follow that trajectory at all, not even close, because again, it goes back to the commercial bank lending. So if you had the banks in Japan lending a lot less, even though you had the government spending more, and then the Bank of Japan just buying that debt, which is why their debt to GDP goes up, so much, then that could, on net balance, that could create fewer yen in the system. And then also the Japanese are a net exporter, so they have significant demand for yen outside of the country, because we have the opposite, where we run big trade deficits. So we export a lot of dollars and we import goods, where they do the opposite. You see, they import yen, suck it out of the system, and they export goods. And therefore, that's why you haven't seen the yen completely crash. But there's a lot of components. But the main reason is because they're doing QE, if the banks are doing a lot less, it still means on net balance you could have a decrease in the amount of currency units circulating, chasing goods and services.
And don't forget about Japan's demographic problem. That's, I think, a big part of it too.
Yeah. All right, guys, I gotta get over to my live stream here.
Okay, someone was just saying that. That was one of the comments, George.
Yeah, that's good. That's a good one, though.
Yeah.
George has to get over to his live stream.
All right,
well,
guys.
Kenny,
I'll see you later. I got to shoot out.
Okay. Hey, Kenny, you want to wrap it up with a couple of real estate things?
Yeah, George. Thanks again. Good luck on the live stream.
Yeah.
Appreciate you jumping on.
All right. How do I
you can just go ahead and exit out, and there you go.
Yeah, let's wrap it up with some real estate stuff.
Yeah, sounds good. So one question, Kenny, and I there's so many questions in here. I don't know that I can find it to put on the screen, but what property management software do you use? Now, you probably use Buildium or one of the bigger, more commercial grade systems.
I'll answer.
Our people use Property Tracker a lot, and that's my system. But go ahead. Yeah.
So we use a property management firm, a property management software called Yardi. Yardi's, but it depends on your size, Jason, but I think, that's been the reason we use it is because it integrates with a lot of institutions and commercial banks, and a lot of people are on that kind of platform. But there's also another RealPage, Yardi, AMSI. Those are all software platforms that are really, really good for property management.
And you would categorize those, I think, as like commercial level property management softwares, right?
Yeah. And the reason we use them is, think about what we do. We do construction, we do property management, we're doing development. And so we need a software platform that, kind of works with all of those things. In addition to that, a lot of the, let's say if you're going to partner up with an equity group or private equity group, a lot of their platforms might be on, a lot of times you have a platform to platform issue. So especially if you start to put deals together with bigger equity groups.
Sure. And so just understand, when Ken answers that question, he's an apartment syndicator, thousands of units, and much different than the way I'd answer that question for the single family home investor.
A lot different.
They use our system, which is Property Tracker many times. And, I started in a YouTube channel called Real Estate Tools and Tech. And I did a demo with Inago, which I thought was a great software for small investors, very different than what Ken does, obviously. So good stuff. Property Buyers here says Tenant Cloud. I'm not that familiar with that one. I have heard of it, but that's good. And Ken, any other thoughts on real estate? Like, a lot of people were asking real estate questions.
Yep.
Let's go there. And I can't find them all now.
Yeah, that's all right. Well, can answer whatever you like. We just closed on 650 units. So obviously I'm still very bullish on the rental market moving forward. 2 properties next to each other in Katy, Texas. And, a big value add on that particular deal. And so I still think there's plenty of deals out there. It's very, very, very competitive, as you know. But I do think, Jason, we're going to start to see, in the pandemic, we didn't see a lot of rent growth, as you know. So, a good year and a half, we haven't seen really any rent growth. I think
we're sure seeing it now, though, don't you think?
We're starting to see it now, and
like
I just think we're the tip of the iceberg. Yep.
Yeah. So, and when you say we haven't seen rent growth, you're talking about apartments when you say that.
Yeah, well, pick a submarket. We can just talk about that. I mean, it doesn't really matter. You got submarkets that have gone down and some submarkets that have gone up. I'm not talking about a price appreciation. I'm talking about rent. So, we had a lot of dysfunction on the rent side, on the collection side. And so we haven't seen significant rent growth during the pandemic. Let's just put it that way.
And here's one.
Have you seen it on single family? Have you seen massive rent growth on single family?
Definitely. I am shocked at how much rent growth there has been. And I'd say it really started about maybe just before the end of the year. I want to say last November, we started to see real rent growth where if tenants moved and they re-tenanted their property, they could achieve 30% increases. It was unbelievable.
We saw,
And,
and that's actually about when we saw. That wasn't very long ago, really.
Yeah.
We started to see that once we kind of got through what I would consider to be, that first 6 months where we weren't sure, what kind of shape people would be in financially and whether they would pay us even. Then everything started to settle out. So this question on the screen here, what's your thoughts on the self-storage? So I'm in the self-storage business, so we own them. And this is something that I know. I'm very bullish on this industry, but keep in mind, there's a couple drivers on self-storage. If you think about it, it'll make sense. One, are rooftops. So if you look at single-family growth, which is it's going to be very interesting to see what happens as it all moves around. That puts pressure on self-storage facilities in those particular areas. So
what do you mean, Ken?
Let's just pick on San Francisco. If obviously people are moving out into the suburbs, it's going to hurt self-storage in the city and create demand outside of the city. And so as you start to see growth or even properties that are added, like right now I'm up in Coeur d'Alene, Idaho. There's a lot of development and a lot of single family housing being built. You're going to have demand. There's other areas that are contracting. So you do have that. And then the other thing I think that you could see as people start to exit from their homes and scoop equity, they're going to have stuff. And they're going to store it. That's typically what they do because they're like, we're gonna buy again at some future date. Again, it depends on where, but I do think that they're going to move stuff into wherever they want to move that stuff, and they're going to downsize. They're going to travel. They're going to rent. They're going to do whatever. And I actually did that personally. I sold a home, and I put all my stuff in a big 75 or 50 foot long place, and I'm gonna have it all shipped down to Arizona at the end of September. And as I got out of one house and I'm trying to take a look at another one. So I think that it depends largely on where people are going, and I'm a massive fan of self-storage.
Yeah, and I love self-storage. I've never done a self-storage, but I really want to get into that. The one thing that's interesting, though, is as we've seen this movement from urban to suburban and even rural markets, and this one makes me wonder, Kenny, because when people live in the city, they have small places, right? When they move to the burbs or the rural area, they tend to get bigger places. So they have a lot more space to store their junk. So, it's kind of hard to determine how that all plays out, isn't it?
Well, when you put it specifically like that, then yes, of course, when you move from a small place with hardly anything to a bigger place where they're going to have more, you're 100% right. That's not actually what I'm talking about.
Okay.
What I'm saying is that as they move to if you ignore the urban issue, and there's tons of storage in downtown urban cores, tons, and that could be for office buildings, storing their, a lot of it has to do. Self-storage is not just for the individual.
It's for companies and
of course, yeah. Right. I mean, most companies have a storage unit somewhere.
Sure.
And so, there's all of that stuff happening as well. The one thing that scares me about self-storage is this. It doesn't take very much to build one. So you only need a couple acres.
Yeah.
They're not very expensive.
They're like Tinker Toys. You can build them really fast. Yeah.
So you can get oversupplied in an area pretty darn quick.
Mm-hmm.
I've seen that happen in markets where there'll be one or two, and then all of a sudden there's 5 or 6, within a 3 to 5 mile square radius. And like anything, and the other thing I don't like about self-storage is there's no real value add. It is literally price sensitive. So, a 4x8 or a 6x10, whatever it is on one block versus, a half a mile away, given the same kind of vintage and, everything kind of being equal, they're very, very similar. Even stuff that might be 20, 30 years old might only be $10 or $15 less. So it's not a big value add play there.
Right. In other words, nobody comes to your self-storage unit and comments on how much they love the curb appeal or the wallpaper.
You have to be safe. You have to have gates. It has to be, all the security and all that kind of stuff. So that is a factor, obviously. But at the end of the day, they're very price sensitive based on new supply.
You heard it right there, folks. That's a good point Ken's making. We'll wrap it up here, Kenny, in a minute, but just a couple more of these real estate questions that are coming in because we didn't get to too many of these. I've got my opinion on this one on the screen. What do you think?
I'd love to hear it. Yeah. Well,
okay.
I think Los Angeles is a very big market. But I'd love to hear yours.
I think that California in general is just really doing a great job of driving people away, at least driving people away who are taxpayers and who contribute to the system. Now, the ultra wealthy, sure, it's not going to move the needle for them. If they want a view of the ocean, the Pacific Ocean, they don't have to move, and unless they're just philosophically annoyed with California's overregulated, overtaxed, and overcrowded environment. I grew up in Los Angeles. I'm not bullish on LA. Of course, LA is a big, giant place. It's sprawling. So it depends where. There will be certain areas of LA that are not affected by the rising crime rates, the homelessness disaster. And I don't want to say problem, it's a disaster of epic proportions. California's got all kinds of very new creative tax strategies to how they can tax people. They're going to tax people with mileage. They're going to require electric cars by 2035, and they can't even keep the power grid working. I have to say, I'm just not overall bullish on California in general, and definitely not LA.
Yeah, I would agree. I think, again, it depends on the area, but I think if you have the ability to not be there, and then I think that's kind of the differentiator, in my opinion. There's a couple things I think just points here I want to make. One is it takes a very, very, very long time to ruin a city.
Yeah, that's true. Just like it does to ruin a country. That's a great point, Ken.
I'm watching that happen in my hometown of Seattle. And also in Portland, where I just sold a property. And I think that, so people need to realize this is going to be a long, long, long slide. Yeah. And so it's going to happen by a death of 1,000 cuts. The other thing that's going to happen, I believe, is you're going to start to see some pretty serious property tax increases. And, they're going to go after the landlord. And they're going to go after the homeowner even more than you guys are seeing it at right now, because the city, the county, wherever you want to draw the line, it's not going to reduce its budget. It's not going to say,
that doesn't happen with government.
It's not like a normal business. So, like if my business, if I lose a big client,
you're going to lay people off and you're going to cut costs.
That's not happening here. They're going to figure out, how do we pay for what we have now? They're not going to reduce the size of their government. And so, and these social services and the needs that you just brought up, it's been a problem for a while. It's just now going to be even worse. And so I think you're going to start to see more and more and more people, because of the affordability, even though the prices might go down, I don't think it's going to matter, because they're going to hit you on the property tax side and the utility side and some other areas. So even if the price of the home goes down, I still think it's going to be a very, very expensive.
I would argue that one of the things that's allowed California real estate to do as well as it has for decades is Prop 13. And when that passed in 1978 with Howard Jarvis, that was such a win for California. Yeah. And it really boosted that state for a long, long time. And as Prop 13 gets whittled down, and, it's already had one cut, it's going to have more, in my opinion. We're going to see taxes go up. Ken's right about that.
Yeah. So to your point, David, or Jason, that is a great point, because that Prop 13, for you guys that don't know what that is, basically they minimize the property tax. And I actually went through a property tax battle in California on this issue. We ended up winning. I think, didn't they go after the commercial? Didn't they lift that on the commercial side, Prop 13?
I thought that was in effect for commercial properties. I think what, over $30 million or something. I can't remember.
Yeah, so that
We
just
reported on it.
happened within the last year, I think.
Yeah.
And so the point about that, if you guys should Google this, take a look there. I think that was kind of, they start there and they were planning on kind of going after residential next.
Yeah,
And if
I agree.
If that happens, the gloves are off, guys.
What I always say is you never want to live under a government that is desperate, because they will become predatory on their citizens. And that's what we have. But to your point earlier, Ken, I think it was a really good point you made. A lot of people with all these doom and gloom predictions, they get all worried about stuff. When Obama got elected, all my Republican friends were freaking out. Oh, America's over. It's the end of the world. And I would say to them, look, yes, Obama is bad news in my opinion, but it takes an awfully long time to destroy a country this great. There's checks and balances. There are 3 branches of government. That's what the founding fathers figured that out. They knew this kind of stuff would happen. And then when Trump was elected, all the liberals freaked out and said, oh, America's over. I'm moving out of the country, blah, blah, blah. And you know what? Guess what? It wasn't over. And when Biden, I don't want to say got elected, because I don't know that he was elected. But when Biden came in, everybody freaked out and thought everything was over. And folks, it takes a long time. This is a very long, slow process. Don't panic. Okay.
Yep.
No, don't panic. Yeah.
It's true. I just would be careful if you're a landlord or even an owner. Just know that you're going to probably see property taxes go up, and you're going to see, if you're in an area where there's rent control, like Oregon, so they're basically hedging your income, and they're controlling your expenses on so both sides of the equation. So perhaps not a good place for you to be when there's a lot of areas that maybe are a little more friendly.
Yeah, I agree. Hey, maybe we'll make this the last question. I know we got to wrap it up, Kenny, but since this one, they mentioned you, I thought I'd
sure.
Put it on there.
Chad, okay. Thoughts on the Phoenix Scottsdale area? I agree with you, Chad. I just actually closed on a house in Scottsdale on Friday. And the reason I bought it as a rental, because it was affordable, oddly enough, in Scottsdale, and it was $100,000 more than it was a year and a half ago. But rents are going up like crazy, and so and there's a whole reason why I bought it. But if you take a look at Phoenix and compare it to a lot of the markets where people are coming from, we're still very, very affordable, just in general. I know, Jason, you've lived there before. I've always thought Phoenix.
I love it. It's like one of my
diamond
favorite
in the
cities.
rough,
Yeah.
and Scottsdale, and obviously, Phoenix. This is a big area. There's areas in Phoenix that are not going to do as well as other areas in Phoenix, but there's just so many people moving right now personally to Arizona. It's again, I always say it's math. Follow the moving trucks. They're all coming to Arizona. Not all of them, but a lot of them are coming to Arizona. And the demand's there, and it's a bidding war, and things are going to keep going for a while. And I still think it's extremely affordable, where you can rent anywhere in those markets right now for in the low $1,000 a month to $1,500 a month range.
Yeah. Phoenix is a great town. I lived there for 6 years, Scottsdale and Tempe, and I loved it there. So it's great. I'm going to be coming out to see you in October, and then again for our event in November, Ken, which is going to be a great event. I'm looking forward to it.
Yeah, if you guys are interested, shoot on over to thecollectivemastermind.com. Take a look at it. We're excited. We're having our first event at the Mauna Lucia in Scottsdale, Paradise Valley area, Tatum and Lincoln area, and we're going to have the 3 of us live there. And I would encourage, if you guys are looking to move the needle personally, we're going to obviously be there. But then the people that we plan on bringing to the event, I think you guys will be very, very pleased.
It's going to be it's going to be a real opportunity for you. And also, I saw a question in the thread earlier. If you go to the collectivemastermind.com and you do that quick application there, it's just super quick, takes no time at all. There is a $2,000 deposit. And if you don't end up joining the group, that's refunded. It's just, it's just a hold, so we don't get a bunch of unserious people. This is a group for serious people. Okay. This is not a, it's not a light thing. It's not a one-day seminar or something, right? So keep that in mind. But I think you'll like it. Just check out what we have to offer there. And like Ken said earlier, all of us, George and Ken and I, we all have membership programs, right? Ken has his premium program. I have the Empowered Investor Inner Circle. People buy that for $1,300. George has Rebel Capitalist Pro. I think that's about $1,000 to $1,200 a year. And those are all included. You get all three of our programs, our individual programs, as well as the Collective Mastermind, which consists of 3 weekend events and 1 vacation event every single year. Look, you're going to go on vacation anyway. You might as well go with some like-minded people.
Yeah, no kidding.
Once in a lifetime experience, learn a bunch of things, make a bunch of new connections. It's going to be great.
It'll be great. Yeah. And I'm just excited to meet everybody and see everybody in November. I for years have said, I don't want to do live events. I don't want to do live events, but this is a great opportunity for me to kind of wrap my head around this and to teach people how to do syndication and buy big projects, negotiate with some of these big lenders and property management issues or anything that you might have. I'm going to be there as a resource.
Good stuff. Well, Ken, thank you so much. It's always great to talk to you. Everybody, cheers, and check out the collectivemastermind.com. And thank you for all the great questions tonight. Thanks for joining us. And we'll see you on our respective YouTube channels and podcast. And happy investing, everybody. Take care.
Hey, and go Phoenix Suns. Let's go.
There you go. See you later, everybody.
Cheers. Bye. All right. Bye-bye.